Good afternoon and welcome to today's UTS Finance Masterclass, COVID-19 Economic and Financial Shock, an Early Australian Perspective. My name is Gerhard Hambusch. I'm academic staff in the Finance Department in the UTS Business School, and I'm very excited to welcome you to today's event. After UTS has successfully switched now to online teaching and research, we're very excited to reopen our online doors for you to celebrate industry and stakeholder engagement in the UTS Business School. Today's event will feature a presentation by industry professor Warren Hogan, who is working with us in the finance department. We also welcome two special industry guests who are Nathan Lim from Morgan Stanley and Vimal Gore from Pendal Group here in Sydney. To now remain on schedule, I hand it over to industry professor Warren Hogan.
Thanks, Gerhard. Today, I'm going to spend about half an hour, 35 minutes going through sort of the work that's been done on the initial shock that the COVID-19 crisis represents to Australia as economy. It is an attempt to shed light on some of the data and issues as they stand. I don't think anyone really knows where we're going. That's part of the problem. I can say, as someone who's spent 25 years monitoring the economy and global financial markets on a daily basis, that I've never seen anything like this. And so what I want to do today is just really throw around some ideas about how to think about this, some early data, and you really just shine a light on some of the issues. I do not pretend to know where we are going, but all we can do is try and map out some sort of the idea of what kind of paths the economy and financial markets can take. I will do this within a financial markets framework. That is my background. Before joining UTS, I worked in banking and financial markets as an economist. So I'll always try and keep it in the perspective of the financial services industry, and obviously coming from the finance discipline group, this external event, I think that's utterly appropriate. So before I get started, I just wanted to share, well, first of all, the format. I'll talk about the initial shock to the economy, which we're experiencing right now, and quite incredible that this is all played out in the matter of weeks, to the point where today's Australian Bureau of Statistics March employment numbers have not picked up any of this impact at all. The unemployment rate went up by 0.1%. And employment actually grew, according to the ABS, in March, and that's largely because their survey period occurred in the middle of the month. And so this is all literally played out in a matter of weeks. So some insights into that, some insights into how economists, all the way from your international institutions to our Treasury and RBA, might be thinking about this, some of the shortcomings of modelling, the importance of data, the importance of thinking things through, the importance of engaging with the economy, with people in business and in financial services to understand what is happening is in terms of trying to form our views on this. So what that sort of overall shock looks like, and get some sort of idea of that. Then I think one of the key issues now is for Australia is the impact on our banking system. I want to just make a few comments on that, and then some comments on what the exit strategy looks like. In terms of, I think, starting point, this is not the Great Depression, okay? So we can just rule that out because we're hearing that almost every day. The Great Depression was an economic and financial shock, not too dissimilar, in my opinion, to 2000, the tech wreck in 2000, and it might have even been less significant than the global financial crisis or the financial crisis of 2007, 2008. What made that economic shock, that financial shock and subsequent economic downturn into the Great Depression was bad policy response. It was tightening monetary policy, tightening fiscal policy, and putting up trade walls. That's what made the Great Depression great. And of course, that really is the birth of modern macroeconomics. Keynes, and the story goes on from there. We have not seen that from our authorities here in Australia and all around the world, quite the opposite. So the Great Depression is not the right reference point. This is an unusual shock. In fact, I've thought at various times in the last 3 weeks that you could not have asked an economist to come up with a more diabolical shock to an economy outside of some sort of climate or conflict type scenario. This shutdown is quite severe for the functioning of a modern economy. To give you some perspective, a modern recession seems to be associated with unemployment getting to 10 or 11%. In Australia, we've had two modern bad recessions, 1982, 1991. Both times, unemployment got to 10, 11%. The Great Recession in the United States in 2008-9, unemployment got to 10 or 11%. Unemployment usually peaks well after the initial shock, and we are seeing unemployment go very quickly to levels that are historically associated with a bad recession. Now, whether that means this is going to be worse than pre-recessions or better remains to be seen, but that is certainly a very concerning element of this shock. And the other thing that is happening here in terms of the financial system is, unlike the GFC, which a lot of people are obviously referencing because it was the last major economic downturn, that was a shock that led with a financial problem, a financial seizure. This is a real economy shock led by government policy, and the financial repercussions are being felt after the real economy, or there'll be stages of this. So we've seen obviously a significant financial adjustment in financial markets. I'll talk about that briefly. But the thing to be very mindful of when thinking back to the GFC is that the financial system seized up, and that led the shock. The real economy lagged. It's the other way around. And in a way, the dog is wagging the tail because, you know, the financial system is there to service the real economy. Okay, so let's start with the initial shock. This has happened right now. Here in Australia, we were already feeling some impacts from China and their shutdown around particularly education and tourism supply chains, but really in March with our shutdowns of businesses and lockdown of the broader community, we're really feeling it quite significantly now. I'll go into what that means, what are the dimensions, then some monetary policy overview and fiscal policy overview. I see this initial shock as essentially a revenue shock, forcing businesses to close, which really rapidly turned into an employment shock, as businesses with no revenues had to lay off workers. And of course, ultimately, as the dust settles, we're seeing this in terms of the macroeconomy as a household income shock. And we'll talk about that vis-a-vis the policy response we've seen. So these are the early estimates of the impact on employment that I've been working on over the last little while. They are guesstimates. This is the kind of work that Treasury were doing, that RBA are doing. There is no economic model out there that will give you insight into where unemployment is going right now. And this is literally ringing up, speaking to people in industries, getting an idea of what is happening on the ground. We know the most directly exposed areas. So I have an estimate of the job shed rate, and that is literally the percentage of the workforce that is being shed in different industries. These are all the industries across the economy as per ABS definitions. And then since we've had the JobKeeper put in an estimate of how many people will be put onto the JobKeeper, but are effectively stood down, not working, so therefore only achieving a JobKeeper income, which I would call as a basic income. So the first point here is the employment shock is what's leading the economic downturn, the economic shock, and of course is of most concern right now. And it's quite clear that in the most affected areas, it is substantial. Accommodation and food services, particularly food services, there's 900,000 people employed there, 7% of the workforce. In food services, it's about 600, 700,000. That sector is shuttered with the exception of takeaway. And the insights I'm getting is that, for most restaurants and cafes, takeaway means you only need to sort of run, a quarter or a third of the staff. And of course, a lot of places just aren't open at all. They're not doing takeaway. Then we've got all the impacts around transport, Qantas, we all know those stories. So they're the numbers, and that's how you get to 1 million workers. And as I'll show you other data, it is quite clear now, although it wasn't when these estimates were initially being done a few weeks ago, particularly in the lead up to the government's announcement of the wage subsidy. As Treasury were working through it, as I was working through it, it was a guesstimate what's happening in the broader economy. But I'll show you a survey that literally is going to be released tomorrow that I work with on the SME sector. And this is impacting across the economy. So you have a direct impact on these heavily exposed industries, but all industries appear to be being impacted. So that's sort of where you get these numbers of 1 million workers, high impact industries, but the job shedding and the revenue declines are happening economy wide. Obviously some very muted areas. And again, I just emphasize these are guesstimates. And then there's some areas that are, hiring people, but the extent of the hiring is nothing like the job losses. So what has the government done? Just to go through the narrative, I can only praise the government for what they have done, because they've shown extraordinary agility. We do have a problem globally where we've relied on monetary policy for decades. So fiscal policy is not agile. It is not used to deploying quickly. We saw efforts in the GFC, which in this country were successful, although a lot of contention around some of the programs. And there will be contention around these, but we have seen the government respond. The first package, of course, in retrospect, looks quite inadequate, $20 billion. It was a lot of money at the time, but that was mainly focused on where I think, the initial concerns were about, shutting down parts of the economy, is the solvency of small and medium enterprises. And that was where the $14 billion was aimed. And there was a little bit of money given to people on existing programs, welfare programs, and on a view that that was going to get into the economy quickly. Now, where the only problem with the government policy response, I think, has come is package 2, where we saw the significance of the problem playing out. They really upped the spend, still focusing on SMEs and households. But the misstep, where Australia diverged from many other countries, was to boost the social safety net rather than to put in place a wage subsidy. So they doubled the job seeker, i.e. the dole, the New Start, whatever you want to call it, which was, is expensive to do, on the view that as people are losing their jobs, would provide a basic income to them through the welfare system. But of course, that was announced on a Sunday, and by 11 a.m. on the Monday, we had queues going for hundreds of metres at every Centrelink conference in Australia. And that was where must say I've been extraordinarily impressed with the government's ability to shift. This isn't a government that's naturally ideologically presupposed to doing something like a wage subsidy. I think it was a great help from a political point of view that Boris Johnson in the United Kingdom and the Conservatives there had done this, but they did pivot and they put this wage subsidy in place. And the size of it, as we all know, is just tremendous, and I'll touch on that. So we have seen essentially a massive fiscal stimulus provided through low and middle income earners to them, and then also support for SMEs to help them stay solvent, help them stay in business, and help them continue to have staff, hire staff, or keep staff on the books. And then now the wage subsidy, and I'll have more data on that. Just to give you some idea, I mean, for someone like myself, I've never even thought I'd be looking at things like the total private sector wage bill in Australia. Q4 2019, last official data, total wage bill in Australia, $183 billion for the private sector. And the government literally had to look at that and said, well, how much of that are we prepared, or are we going to need to pay for? And as it turned out, they have gone with 130 billion. It's only an estimate. I'm sure the number will be different. I'm hoping lower. I'm sure everyone is. 130 billion over 6 months. That's not only 12.5% of GDP. It's 35% of all private sector wages in Australia, from the CEO of a bank to every other worker out there. So there's a lot of people who aren't, a lot of industries, a lot of firms that aren't open to the job keeper in the private sector. So they're literally paying the wages of a huge chunk. I'd say half of the eligible firms. Now, this survey, which is going to be released tomorrow, so you're getting a sneak peek, is from the Executive Connection, is a firm I do some advice for. There is SME mentoring company. They have 1,200 members across Australia in all sorts of different industries. And this has been their normal quarterly business survey. And this is data that has only just come in the last week. Will be of great interest, I'm sure. But essentially, half of these businesses are not going to access JobKeeper. So that's great news. They don't need to, but half will. And to give you some idea, less than 10% of these businesses have been shut down. So the members of tech are not restaurants and cafes. They're not small tourism operators. These are proper mid-sized companies. But yet the level of distress in the economy has been enough that half of them still need to access this. So there's good and bad news in this. There's good news in the sense that they've got access to this, and this will be a great support to them. The bad news, of course, is that they're going to have to access this. All right. Now, looking at this, there's been a lot of talk about what we thought would happen with unemployment. And there was a very important analytic prior to the job keeper coming in. I must apologise, that chart's called job seeker. It should be job keeper. It's all very confusing these days. But there is reports, and I had an estimate of unemployment going to over 16% without the job keeper program, because there was mass shedding of labour going on because businesses did not have revenues. They could not. These are not businesses that have big buffers. They do not have big reserves. They do not operate at large margins. And if they aren't getting revenue, they're not able to pay their staff. So the first port of call was obviously to shed labour, as we saw. The JobKeeper has been, I think we'll find out, will be extremely successful. I think half of the jobs that could have been lost will be saved and people will stay on the payroll. How long for? It depends on the extent of this. And then I'll come back to the dynamics going forward. But the key issue here is that there will be this surge of unemployment over the months ahead. Then once social distancing restrictions are eased, once we start to normalise, you'll see a lot of people go back to work, even unemployed people. But the question then becomes, what state will the economy be in then? And I'm not confident that we're going to see the unemployment rate come anywhere near back to where it was. And I actually am concerned that we'll see it actually start to go up again, sort of this idea of a W. But that's just at this stage my sort of core sense of the outlook. That would be if I had to have a view, but there's obviously significant uncertainties associated with that. So we've talked about the revenue shock to business, the employment response, the government policy, and then this is the household income, my assessment of it. Now, these are guesstimates, and it's just focusing on wages and social security as household income. It doesn't talk about property. It doesn't talk about any of that sort of stuff. But looking at this is a nice schematic for thinking that this JobKeeper program, combined with the significant expansion of welfare programs, will mean that the government has successfully supported household incomes. I think we're going to lose a lot of private sector wages, even with JobKeeper maintaining people in jobs, even if they're not working. But if the numbers on 10% unemployment are right, then we're going to see a significant loss of wages there. And I think we're hearing lots of stories of wage cuts, mainly senior executives, but not exclusive to that. We're going to hear lots of stories of people having their hours cut. I think one of the most important bits of data from the ABS employment numbers going forward will be the hours worked data rather than the actual unemployment rate or even employment numbers, but hours worked. And so I think we're going to see a pretty significant decline in private sector wages despite JobKeeper. And thankfully, that's going to be offset by a significant increase in the job seeker. So that was costing the government about $1 billion a month, $3 billion a quarter, $12 billion a year. And their estimates have it going up to, well, the total cost of it, I think is about 12 billion, something like that. But my estimates are that you're going to see that double for everyone. We've already seen that announced, and then a big increase in the number of people using it. So that's going to put a big upward shift via that program on household income. I've got 265% there, off a low base, obviously. But then there's all the other programs, the 2 one-off payments to pensioners, all the other programs that are getting support. These numbers are estimates based on the government costings. And so, look, even though I think, and it's really, again, we're just sort of making guesstimates at this stage, that consumer demand could fall anything from 5 to 10%. Economic activity, I think, could fall as much as 8%. But household income, I'm more confident that the declines will be less, something more in the order of 0 to 5%. And that's really good news. Good news for people more generally, but good news for demand in the economy. So back to the comparison with the Great Depression. Why did government policy fail? Because government policy didn't do the 2 key things you need to do in an economic downturn, and that is support a basic income in the community, keep people spending, and support businesses from failing. Now, there will be businesses that will fail, but you want to try and minimize the amount of businesses that have a long-term future that fail because of the short-term shock to the economy. And in terms of that first one, providing a basic income, we're definitely seeing that. The wage numbers, I'm again guessing, but just to give you some idea, we're going to see a decline in wages, I'd imagine. I mean, I haven't gone through the ABS numbers line by line, but from the anecdotes I'm hearing, we could see a significant sort of shock to wages. And this is a deflationary event. Don't let anyone tell you otherwise. There will be pockets of inflation around supply chains and various things, but generally speaking, this is a very significant deflationary event, and that'll show up in wages. Okay, the monetary policy response has been clear. The RBA at their March meeting cut. They had an emergency meeting and a press conference. They cut again and took the interest rate to the effective lower bound, 0.25%. All other central banks have essentially gone there, those that could. You can see here what the US and the Canadians have done. And of course, the RBA has come out and taken their first steps in unconventional easing, which is effectively not quantitative easing. It's effectively expanding their interest rate targeting. So their interest rate targeting has historically been the overnight rate, the cash rate. They've expanded it out to the 3-year government bond rate. And that makes a lot of sense because in Australia, we're largely a floating rate economy. 90% of mortgages are floating rate. A lot of corporate funding goes on in floating rates. But when we do fix, we tend to fix out to that sort of 3-year mark, whether it's a mortgage or corporate or business loans. And so they're just trying to target that interest rate. Of course, that created some issues in the bond market, which I won't go into. But it's not quantitative easing as such. But the technique through which they achieve the 0.25% government bond rate is laying the foundations for quantitative easing. I haven't got the data on the government's deficits. I think we've all seen the news reports. They're going to be substantial, nothing like we've ever seen before. And this is going to be very important that the RBA has the capacity to enter the government and state government bond market and buy securities should the government have any problems getting their securities away. I saw I'm not following the AOFM closely on a day-to-day basis, but I saw in the paper they did 13 billion, which is a fantastic amount of money to get away. Just remember, the AOFM have to issue to a private investor. The RBA can only buy in the market from a private investor. RBA can't be involved in the primary tenders and so forth. But that means, of course, if the government runs into any trouble with its funding, the RBA can come in and support the market as part of its current policy. Or indeed, if there's real problems in the market, which would be global in nature, I think, they can actually explicitly come out to the market and say, we're doing QE, and that is going to involve buying 100 billion or 150 billion of government bonds over the next 12 months or whatever the metric is. So that's very important for the smooth functioning, not just of the government bond market, but of course of the government's financing mechanism and the ability for them to deliver these programs. You're starting to see it already show up. This is the RBA's balance sheet, the blue line, and you're seeing essentially what you see in a financial shock. You're seeing money rush into the banking system. We saw this in the GFC, whether you call it risk appetite with an investor perspective or you call it precautionary savings from a consumer perspective, but banks tend to get a lot of deposits. So their exchange settlement balances at the end of each day are big, but that's been offset by the fact that the RBA is out there starting to buy government and state government bonds, and their holdings of those Australian dollar investments, as they call it, have surged. So these are the first steps for that unconventional monetary policy. So really, the Reserve Bank has now a traditional central bank role of monitoring the financial system, making sure it works. This is where obviously a very close relationship with APRA is important, and why in the old days, the central bank used to be the prudential regulator. But anyway, I won't go into that particular story. And they need to make sure that the government's financing mechanism is intact. And of course, all that sort of in the background will help keep the stability of the currency and all those traditional things. But there's no more interest rate sort of adjustments there. They've made it very clear cash rates are at 0.25 and staying there for the foreseeable future. Government financial market response. I think I would characterise it, after having watched up close a number of crises in my career, starting probably the first big one was LTCM and the Asia crisis, right through to the GFC and the European debt crisis, I think was probably the last big one. But this is a standard financial market response. Bond yields rally. They're 10-year government bond yields. That's the rally we've seen. We see currencies move in the traditional fashion, i.e. deficit countries or capital importers, they get hit. This is the UK and Australia. Capital exporters, the yen, it rallies or stays strong. And then the reserve currency, the big dollar, it gets supported. We are seeing a traditional financial market portfolio response. Home country bias, de-risking, this sort of thing. And then equities, of course, this is an index across all of them, high correlations. and going only down about 25%. The implications of what I'm saying is that if there are further real economy problems ahead, I think the financial markets will reflect them. They've only reflected what we've seen so far, which is quite big, but still, unless the economy does really settle down, I think there'll be more challenges for financial markets ahead, because this is not a financial market-led problem like the GFC. This is a real economy-led problem. I believe this is an equity event. This is a profitability event. And I find it hard to believe, and this is not financial advice or the traditional stuff, but I find it hard to believe that equities are going to have a 25% hit and be done with it, and it's onward and upward. Despite the significant liquidity provisions from central banks, and the Fed has done everything except for buy equities, it seems. But the underlying fundamentals of this, which I think we're going to get revealed over the weeks ahead in the earnings season in the US and in other countries, is that this is a significant revenue earnings event. And that's the long history. I just sort of think that tells you all you need to know, that to think that we're just facing one of the most severe economic shocks in history, and that the US is sort of hardly had a blink is quite incredible, really. But maybe that's the way it plays. Maybe we get the V shape, and maybe the equity market's the right thing to be looking at right now. I'd love to think that's the case. Something deep in my bones tells me it's not. Okay, secondary impacts. I'll get through this quick. Sorry, Gerhard?
10 minutes left. Thank you.
Okay, sorry. Okay, so there's a lot of material here, so I'll just get through this. So first of all, how do we think about the bigger impact on the economy? I've talked about the initial shock. The BIS has got a nice paper on their website because they've sort of run some numbers, and obviously we're now starting to see the IMF and OECD and World Bank and everyone come out. So essentially, the way they're thinking about it, and I think it's the right way, is initial shock and then the secondary impacts. The history, they say, tells you that whatever the initial shock is to an economy, the overall economic shock, the secondary impacts are often double, sort of 1.5 to 2 times. And so most of them are landing on an idea that this will take between 5 and 10% out of GDP. That seems to be the consensus. Now, then what happens next is you get a recovery. And it can be a slow recovery, and it probably would. The BIS numbers for most of the major economies have the low point in economic activity for most countries in Q2, and not regaining that level for over 12 months. And look, they point out some of the real problems. So first of all, these models that they're using are all based on parameters of the modern era, since the mid-90s, say. And they just may not reflect what is going on here well. This is a unique set of circumstances. We have not seen them before. And I think reading between the lines of the BIS, but also the other international agencies, is that, it's not just that there are substantial uncertainties. I think there are substantial downside risks. I'm worried that this initial shock will reveal existing vulnerabilities. And by that, I mean the problems we were worried about last year, 2 years ago. For me, the big one is our over-reliance on monetary policy in the last decade, and even longer in some countries, and the fact that we have a lot of weak companies in our economy. And does the magnitude of this shock represent a significant solvency risk and business failure risk? I don't have any particular insight into that, but that's certainly one of the key risks to be watching. But going through all of this, I think you can quite quickly paint a picture that the recovery can be very slow. And we've got a lot of stuff going on in the background. I hope that we're not going to be looking at history books in 30 years' time where Trump pulling out of the WHO is a marker in history about a deterioration in geopolitical stability. But I fear that that was a very significant event, and there's this obviously rise of economic nationalism, which was already gaining a lot of momentum. So there is a lot of risk out there, and I think I just find it very hard to think about V shapes. I mean, we can get technical V shapes, but in terms of the reality of the economy, in terms of where we're going to rest on in unemployment around the world in 6, 9, 12 months, it's not going to come back to where it is now. I find that very, very hard to believe, but I hope I'm wrong. And then, of course, right now we're operating with just very little data, and the ABS numbers today just highlight the point that even now we're not getting much information from official statisticians. That'll start to roll. I think employment numbers are critical, but really everything will have insights into this, and we'll be learning a huge amount in the next 4 weeks about the dimensions of this economic shock. And of course, that will inform us our knowledge of what this downturn looks like and our forming of views on the recovery will become quite clear, or a lot clearer in the next month as we get official data. Okay, this is this survey again. This is just to show you how significant it is. So these, as I said, are not necessarily directly exposed industries. These are SMEs operating across all sorts of parts of the economy. This is how many respondents said for different parts of their business, the impact of coronavirus and the associated shutdowns. I'll draw your attention to sales. Only 12% of businesses said they've had no sales impact. That is incredible. Everyone has been impacted, really, with the exception of these 12%. And of course, over 20% say the impact is severe. Good news is they're holding on to staff. That seems to be the strongest element, but they're cutting back on investment. And of course, we all know the supply chain story. That was very much early in the piece. So this is a broad impact. It's not just a matter of shutting down a few sectors and then them reopening. This idea of hibernation, I like it, but it's simplistic and it's naive when thinking about how this economy works. The ABS has done their initial business impacts and they're doing some really interesting stuff. They're going to have some interesting weekly wage and employment numbers out next week. I think we're all waiting with bated breath to see what they look like. But they've come out and they've done a survey of businesses, and essentially businesses, 10% have stopped trading at the end of March. And most of these other industries, just as I showed you, are registering some impacts. That's on their website if you want to have a look at it. Again, back to this tech survey, impact of coronavirus. Generally, SMEs in the economy, not focused on the particular exposed sectors. Very few complete shutdowns because it's not in the exposed sectors. Partial shutdowns, about 7-8%. Huge amount. 30% of SMEs have said their revenues have declined by 30% or more. Obviously, they'll be going for JobKeeper, and that'll be a great support to them. Minor revenue impacts. At this stage, less than 20% of businesses have said there's been no impact or they've actually seen an increase in revenues. Okay, so this shows you that it's spreading across the economy. I would note that a lot of CEOs who are in businesses that have had a 20% hit are somewhat concerned that they don't get JobKeeper. They think that's unfair, that they should have graduated it in because they've had a 20% hit. Their competitor down the road gets a 30% hit. They get a huge government subsidy for 6 months and they don't get it. So that's just an issue that's quite clear in some of their minds.
5 minutes. 5 minutes left.
Okay, I'll speed through. I think I've showed you the unemployment. You know the idea is there that it could come down and then it'll go back up again. The consumer sentiment is fallen. It's coming back, but it's still extraordinarily low levels. This is my conception of GDP, an 8% hit in Q2. I hope I'm wrong. It's maybe the consensus is, the Australian views are from an AFR survey a week or so ago. I don't think we're that robust. Looking at the US, they're looking at sort of 8%, maybe will be a bit lighter, but it is significant. And you do get a V technically as long as you stop growing, you stop shrinking, sorry. But, the issue is after you get the big sort of swirl around in this year, what happens in 21, 22? And I think we're likely to see quite a tepid recovery coming through. This is the NAB survey released earlier in the week, mapped up against GDP. This shock is going to ruin all the axes on all our charts. But you can see that NAB survey has got a very strong relationship with the economy. The RBA looks at it very close, always have. And that's telling you that the decline in GDP is likely to be in this order of magnitude of, this is telling you 4 or 5%. Okay, the banking system just quickly. So the moratoriums are essentially that you don't have to pay interest. You apply to the banks, you don't have to pay interest for 6 months. That'll be capitalized. So first of all, the problem with that is that companies that are weak can get a moratorium, but at the end of it, they're going to have a bigger debt. So that's the first thing to realize in terms of how this is going to look at the end of it. The other one is the BIS and the APRA has conceded that they're going to relax capital, risk-weighted asset requirements, capital requirements around those impaired assets. And so the key for the banks now is understanding what their impairments are going to be in 9 months. Not now. They don't have to put all these moratorium loans as impaired as beyond. They're just in moratoria. That's a coronavirus impact. All the regulators are fine with that. But what's going to pop out the other side? And they're going to start forming a view on it. The American banks have, and there's a wide variation between Wells Fargo, Bank of America, on what their provisioning is already. Funding and liquidity, I'm not going to go into because I think we're fine on that in Australia. And if we do have any problems, the RBA will step in. But if we do get a national downgrade, the Australian banks will get affected by that, and they may cause them to have some access problems to global markets. But the real issue is capital. And this is where the banks are a buffer here. And have they got enough capital? So we've heard about dividends being suspended all around the world, and guidance here to be careful with dividends. And that's because that's capital, that's profits, and you want to keep that in case you've got losses coming. So just quickly, I'll finish off with the banks. Their impairment are low. So it's, you can see the GFC there, the big increase, they're low. That's going to go up, okay? But then this is their capital. They've got a lot of capital. They're well beyond the unquestionably strong. In fact, APRA's relaxed it a little bit as part of the changes in the past month. So banks are in a great position from a capital and even from a liquidity point of view. That's not the issue. The issue is how much impairment's coming. So they got a great starting point. The one thing I am worried about is that their operating position's been weakened. So this chart shows bank income as a percentage of GDP. The two things I'd note here is, one is it's shrinking. So bank profits as a buffer for the economy are getting less as a proportion of GDP. And the other thing that's really important here is non-interest income has been shrinking. So banks are increasingly reliant on interest income for their earnings. And then you can see here that this is the dollar value from APRA data of their interest income, the gross interest income for all banks. And of course, the moratoria will hit that quite heavily. And of course, they're quite reliant on housing. So the housing moratoria, where I think the real stress is going to be in the investor sector through renters and people who lose their job, is something to watch. Excuse me. And you can see that that's just the split between the interest income and the interest expense. I won't go into that now. But the summary point there is that the banks have not got as much of a buffer from an income point of view. Their operating position is pretty good, but their profits are going to get pretty hard. And then, of course, the main thing for the banks right now is understanding what their impairments are going to be when they pop out the other side of the moratoria. And that's really, I think, the real main financial risk that sits in our economy right now. And getting visibility on that will give us great insight into how severe this is going to be and how we're going to come out of it. I won't comment too much on this because I've run out of time, other than to say that as the policy sits now, the moratoria I just talked about on interest payments, the wage subsidy, the JobKeeper finishing in September, all the programs finishing. If we have a hard finish to all these programs in 6 months, the big risk is we've just delayed the shock to some extent, or we'll get another shock to the economy down there. So I think the big issue from a policy perspective is going to be trying to smooth the normalisation process. I think that's inevitable. There'll be political elements of this. And of course, I think the political harmony that we've seen in this country in particular, I think one of the greatest risks to our economy and going forward is going to be that a decline in political harmony, that the old politics comes back, because I can, reading between the lines and looking at the way things are going, the oldest story in the book, socialism and capitalism, failure of markets and all of that, that's a vehement debate that's been reignited by these events. And I hope that it doesn't get in the way of good outcomes, because so far so good, but I see that as a major political risk going forward. I will finish there and pass it to you, Gerhard.
The next part of the program is that we have 3 guests. Kylie will be the first one to step up. And then we have our 2 special industry guests, which will be Vimal Gore from Pendal Group, as well as Nathan Lim from Morgan Stanley.
Okay, so thanks for the great presentation, Warren. So before we lead into discussions from our industry experts, I'll provide a brief background of what we're seeing in the equity markets in Australia. Okay, so since the World Health Organization declared COVID a pandemic on March 11th, we've seen trillions of dollars wiped off the global equity markets. So the single day swings have been the largest since Black Monday of 1987. So going into this crisis, and much of what Warren has alluded to, we've seen markets overvalued, stocks climbing sharply despite the tepid economic growth, and there was heightened economic and political uncertainty. So if we look here at this, at the Nobel Prize winning Robert Shiller's cyclically adjusted price earnings ratio, which is a standard valuation metric, there are only 2 other times in modern history that the US market has been more overvalued than this current crisis. So we can see that here in 1929 and also 2000, and these were forerunners to the Great Depression and the tech wreck. Now, as Warren spoke about, there's been no shortage of discussion about the overvaluation being driven by this ultra easy monetary policy, essentially as a way to prop up the economy via asset price inflation. So the problem we now have is that interest rates are so close to zero, or even negative in some countries. This has left central banks somewhat powerless to tame the market turmoil. And I did see a couple of questions pop in on this particular topic, so I'm sure we'll be discussing that further with Warren at the end. Now, moving into discussions on this market turmoil, what we have here is a chart of the intraday price change. This is for the S&P 200. This is throughout the past 20 years. So this is just simply the high minus the low over the last. And now the insert chart is a zoom of this change here from January this year until yesterday. So we first saw an aggressive reaction to the crisis. So there was a 32% decline in the S&P 200 in Australia from the beginning of the year to the lows, which were hit, I think, on the 23rd of March. Now, investors were responding to what was perceived as an insufficient government response to contain or essentially reduce the severity of the human and economic costs due to the coronavirus. And this reaction was reflected offshore. We saw a similar response in the US with, what I'll say was a misinterpretation that the Fed didn't react sufficiently. I think at this point I'll withhold any views I have on Trump's response to the crisis and leave it at that. So what this means for markets is that the panic response is quickly entrenched in the pricing of stocks. And this leads to poor information efficiency and essentially distorting investments. So ultimately, we have a drop in market quality. And this plays out in a number of ways. So we see a reduction in the quality of being able to effectively allocate resources and also risk transfer in markets. So I guess to put this simply, we see that markets just aren't functioning well at the moment. Now, since the lows of March, we have witnessed a rebound of 17%, or that's come off a bit today, as the infection rate in many countries has slowed. And I think whilst this optimism of some quick economic recovery, with the basis being the unprecedented response of the government and central banks to the crisis, I do expect it will be challenged in coming weeks. And I don't think this is sort of too dissimilar to sort of what Warren was talking about with regards to these equity markets. Now, the tricky part is that we're dealing with a global health crisis. So this is this is something that we haven't seen for 100 years. So we can expect that investor sentiment will remain fragile and prone to sudden shifts that we've observed in the past month and a half. And I feel this will continue to result in higher levels of market volatility. So beyond the response to government and regulators, we can see what economists call the Minsky moments driving the day-to-day volatility. So this refers to a tipping point. So when speculative activity reaches essentially some extreme unsustainable level, and then we see a rapid price deflation and essentially an unpreventable market collapse. And since 2011, which, that's going back 11 years ago now, and outside of, the occasional flash crash and a few other sort of discrete notable periods, there really hasn't been much volatility in asset prices. And now we get to something that is this, very significant exogenous shock, being the coronavirus. And I guess we need to also keep in mind that market participants were previously set up with positions under which there were assumptions that they could get out of those positions. And, these assumptions no longer hold. Now, I don't see this as, having a statistics background, I don't see this as, sort of much sort of any different to thinking about modelling, with using a particular model with specific assumptions, and the moment they don't hold, then, it becomes increasingly difficult to, or you don't get very good predictions from those models. So what we see here is a significant lack of liquidity, increased volatility for liquidity providers, and these pose significant challenges. Now, anytime we go through a bear market or a recession, there's always positions that clients need to unwind or move, and these often come at distressed times, so which is exactly what, I guess those on this call that are in the markets can see. So just with this previous chart, we do see a reduction in these intraday swings in the prices. What we did was we took this a step further. So we wanted to better understand what's actually going on intraday with the markets and for trading. So what does this mean for trading? Now, here I'm not making, I guess, any opinions on whether markets will go higher or lower, but rather sort of considering whether there is some evidence that markets are getting in better shape to move positions. Now, I do invite those in the audience. I can't see the chat now that I'm speaking, but I do invite those in the audience to comment on the chat as to what they're actually seeing, particularly those who are sort of at the coalface and actually trading. So if we take a few simple metrics which are relevant to transaction costs and consider these across a sample of stocks, this paints a story of continued challenge, in my opinion. So what we have here is a series of box plots which are made up of a sample of stocks, and it's to try and give a visualization of the distributional features of these metrics. So we consider two samples taken from the S&P 500 in the US and the S&P 200 in Australia. We use intraday data from various time periods. So the first being this past week. So that's what we have here, COVID-19, 15th of April. The second being the month prior. And then what we call a non-crisis period at some point last year. And then, of course, the GFC for comparison. And on each box, the central mark indicates the median and the bottom and top edges of the box indicate the 25th and 75th percentiles. So what we're interested in understanding is how this current crisis compares to both previous crises, such as the GFC and normal trading times, and also whether we've seen an improvement in spreads and volatility from a month back. So I think what we want to know is if the market is in better shape for transacting positions, rebalancing portfolios, and so on. So the rates of transacting, which here I call velocity across global markets, has been similar to the GFC and much higher than what we might call in normal times. So the electronic systems provide a catalyst to embed panic or uncertainty, if you like, into the pricing. We've seen huge swings in prices and that's at increased transaction rates. So this has come off somewhat in recent weeks, but still well above non-crisis periods. Now, transaction costs are inflated with the spread between buying and selling prices, widening significantly compared with pre-crisis levels, and almost twice of what we've seen during the GFC. And we don't see any changes to this in recent times. Now, this is not limited to prices. So there's still significant intraday volatility in trading volumes, creating uncertainty in the ability to transact effectively. And this obviously plays out quite a lot with the less liquid names.
Kylie, 1 minute, if you could wrap it up, please.
Yep. So if we take a step back and I guess remind ourselves that equity markets are about forward earnings and forward earnings are about consumer sentiment. We do need to recall that for the GFC, I think it took 1.5 years to hit the low in sentiment, and we're only 1.5 months into this crisis. So I see this as now the new normal, and I think it's going to be this way for some time ahead. Having said that, obviously it all sounds quite grim, but I do think there is still significant opportunity in navigating this crisis and how we do business. And there's certainly discussion around regulation because we've seen a significant regulatory overhaul in the past, following the past financial crisis. But there's still areas of fragility in the markets that need to be explored further. So at this point, I'll hand back to Gerhard to introduce our industry guests.
Thank you very much, Kylie. I'm very excited now to introduce UTS Industry Fellow Vimal Gore, who's our first of two industry guests. Vimal is Head of Bond, Income and Defensive Strategies at Pendal Group, and he's worked with us at UTS Finance in several roles, including, for example, promoting women in finance.
I'd just like to offer up a few comments from a kind of practitioner's point of view. Firstly, the first thing I'd like to say is we can, from our point of view, you can ignore the virus numbers now. It's kind of pointless looking at them and looking at the curves and trying to determine what that means because it's all pretty much random. It's about the level of testing they're doing. We don't know what row is. All of the virus numbers are pretty much random. All we know is that the countries that are doing full lockdowns are getting a flattening of the curves and those that aren't. So the US is one of the worst. New Zealand is one of the best. But what point is a flattening of the curve for New Zealand? Because as soon as they reopen borders, assuming they do, they're just going to get the second wave coming in. So it's kind of pointless. First, that's the first thing. So I would just say ignore the virus numbers now. They mean nothing. And also, Warren talked about how bad the numbers are going to be. The numbers are going to be absolutely atrocious. The second quarter GDP numbers in the US, the range is from -9 to -45 down. And they're not just small houses. I mean, Goldman's at -30 something, JP's at -25. Retail sales last night in the US was awful, down 8% in 1 month. To give you an idea, if you exclude grocery stores, which are obviously doing very well, that 1 month fall in March in the US was bigger than the total fall we saw during the GFC in retail sales. Manufacturing number, the ISM probably going to be out about 20. Trend is 50. The low we hit in the GFC was 35. So the numbers are absolutely atrocious, but you can kind of ignore them as well. And I can fully concur with Warren's point is the only thing we need to be aware of or thinking about is how long the virus is around. Now, I'm not particularly optimistic around that. I know we've got the best minds in the world looking at it, but we still haven't solved the common cold. We still haven't solved the flu. And both of these are linked to the virus. So I'm sure we'll be living with the virus for a long time. And the sugar hit that Warren talked about is early. So in the US, to give you an idea of how large the sugar hit is through monetary and fiscal side, the Taylor rule is saying that, you know, interest rates are about -5 now with everything that's going on. And the GDP boost we're getting is around 40%. It's absolutely massive. So if you're a small company with less than 500 staff, you're getting your wages, rent, and utilities paid for 2 months. But the US has pretty much done everything it can do. Okay, there might be some supplementary stuff coming in the background, but when you've already done 40% of GDP, there's not much more you can do. And so if the virus lingers on more than 2, 3, 5, 6 months, well, then what else are they going to do? And that's why I fully agree with Warren that the longer this drags out, all you're doing is delaying the issue. And what the central banks have done is they've given you a massive amount of liquidity, which have solved the liquidity issues, but they haven't solved the solvency issues. And you've bought time for companies in a solvency pace, but they are going to have massive problems the longer this drags out. And also when we come back, how they phase in the return to work, which is going to be very crucial. So that's kind of backward looking. Forward looking from here, what does it mean? I mean, what the majority of assets that run in this world are run on a risk parity basis, which means you have equities on one side, you lever up bonds to the same risk level on the other side, and they give you an inbuilt hedge. But with bond yields at zero, that doesn't work. So how willing will investors be to own equities without the inbuilt hedge? I don't know. So it means that at the least to me, that means you're going to have a higher equity risk premium in the market. Secondly, what do you do with bonds at zero? And ultimately the death of the bond market is bond yields are going to zero globally, which still means you're going to have a very good capital gain over the next period till they hit zero. But then they're pretty much useless because central banks are going to hold them to zero. I've been around in this market since '94, and the comments always used to be about the bond vigilantes, of which I was one. As the fiscal pulse is too large, you sell off the back end of bonds. That sends a signal to the government, and the government step off the gas. Well, bond vigilantes are dead. You know, my role won't exist in 5 years now because bond yields will be held at zero by central banks. So at some point, it has to be inflationary. That there is no question. We're going through a massive deflationary impulse now, but at some point, it's going to be inflationary. And the third thing is what happens to all this debt. I saw there was a question that came up. You know, is government bonds ever going to be paid back? No, they're not. They won't ever be paid back. They're going to be defaulted on. Whether it's explicit default, the likes of which you saw in Greece, or it's implicit default, likes of which is going to be inflation, they're going to be defaulted on. There is no question about that. And that's all the bonds in the world. And when that happens, and if you get high inflation, well, you're going to start questioning the fiat currency system. And so you need to think about what that means for a standard diversified portfolio. And you need to start thinking about alternative assets you can bring in, like crypto, whether it be Bitcoin, Ethereum, Ripple. What role do they have to play in diversified portfolios? You need to rethink the role of gold. You know, and for my portfolios, for my clients and PA, I have quite a large exposure to gold right now because I think this is the perfect environment to gold to perform very well. But there's a number of existential questions we need to be asking ourselves as allocators of capital about what this crisis has done and what it means for the future of the asset markets. And I completely agree with Warren again. You know, a 25% drawdown in the equity markets, when this is the largest drawdown in monthly data we've seen since the 1920s, just does not square up. And it comes back to this fact that they've thrown liquidity at a situation which is not a financial crisis. It's a health and economic crisis, and therefore liquidity is not going to solve this. It's a solvency issue, but they don't have enough money to solve a solvency issue. So we've got this interplay, we've got these numerous things about how bonds play off versus equities, how monetary versus plays off against fiscal, how liquidity plays off against solvency, and ultimately, what does that mean for asset allocation going forward? And these are questions I'm thinking a lot about, me and my team are working on, and hopefully we'll be able to share with you as we do these kind of presentations in the future. So I'll pass it back to you. Thank you for your time.
I would like now to continue with Nathan Lim.
Taking notes as everyone's been speaking, and I'm going to try and fill in some of the gaps and some of the questions that came up. So just going to Warren's presentation first. The way that we're sort of describing what we're seeing in the market, in the economy, is we very much describe this as the sudden stop recession, because you basically have large parts of the economy just literally coming to a sudden stop. I think that's probably a neat way of describing it. In terms of the job shedding that Warren was referring to, what I'd also highlight in there is that a disproportionate share of casual and part-time labor is actually in those most affected industries. So that is why you're going to see, that's the reason why you're seeing so many people losing their job, because these people are generally the most vulnerable in terms of the employed. The JobKeeper program, this is sort of a statistical anomaly. The JobKeeper program is actually going to suppress the headline unemployment number. It's going to make the unemployment number look better, which is why for us, what we're focusing more is actually on the underemployment number, and we're expecting that to potentially go as high as 23%. And that's the key thing that we're sort of focusing on. So like 1 in 4 households will be effectively unemployed. Looking at in terms of the question about deficits, so we've been running the ruler over that. We estimate that with this 3 fiscal packages, the Australian government will probably reach a deficit between 6 to 8% in FY21 and FY22. In regards to what is the impact going to be going forward for Australia, the first thing you should be thinking about is clearly you need to look outside Australia, and the first place you want to look at is China. China was the first hints that we as a firm picked up in terms of there was a problem, Houston, to we actually think that they're probably going to lead on the recovery on the other side. And the specific number that got my team's attention was we were tracking Chinese daily power coal consumption. And basically what we were seeing is that factories were not restarting and people weren't returning home immediately after Chinese New Year. If you've ever looked at the economic numbers in China on a daily basis, it's a very stark V shape, meaning that at the height of Chinese New Year, literally the country comes to a standstill and then it progressively starts up. By about day 3, it was quite clear that the Chinese economy wasn't restarting. What we're seeing now is that Chinese daily power coal consumption is getting closer back to where it should be, so to speak, post Chinese New Year. What we're also seeing is some encouraging things in supply chains. So for example, with steel, up until 2 weeks ago, all we were seeing was iron ore was moving through the supply chains. It was moving through the ports. It was going to mills, and it was being converted to steel. Problem is that steel was just piling up, so that was not good. What we saw a week ago was that for the first time this year, finished steel volumes in China are actually down. So there's good evidence there that China is restarting its economy. In fact, we just had this interesting piece of anecdotal evidence last night that there is actually a vaccine trial for COVID-19 in China. It was canceled because they couldn't find enough sick people to actually put into the trial. So that's another good sign that things are getting better there. One other comment as well was, what's the market? Why is the market sort of finding a bottom here? What we're talking about here, and the way we describe it to our clients, is that people always talk about how the central banks brought out the bazookas. Well, I think what we can say now is that federal governments collectively have now rolled out the howitzers as well, because they're bringing everything to bear. And as a result of the sheer size of this stimulus, it sort of puts a backstop on the markets, and that's how we're thinking about it. And just as a last comment, just on sort of what Warren was speaking to, he touched on this concept about the major banks and the risks that they face in terms of profits. And I just want to elaborate on that. Our modeling, we've taken a look at, well, first of all, we just accept that there is going to be a credit cycle. Even in a worst case, in our worst case, where we modeled a 1990 credit cycle, we estimate that the major banks will still report a profit. The profits will be dramatically lower than where they are now, of course, but they will still report a profit. The implications for that is it means the banks, from a capital preservation or sort of a balance sheet perspective, are going to be fine. What is really more at risk, and I think that's the point that Warren's trying to make, is that dividends are at risk, because as profits go down, obviously dividends go with them. Just looking at Kylie, I think the takeaway I got from what she was mentioning there was that I think this really highlights that now more than ever in the last 10-year cycle, this is the time for active management. Quant models, linear regression, correlation, all that stuff breaks down when you get to these really severe sell-off periods that we're in right now. I think now is the time where good old-fashioned fundamental analysis comes to the fore. And just lastly, in terms of Vimal, he was saying that don't bother modeling the MS, don't bother looking at virus numbers. I think I'm going to disagree with that one. So at Morgan Stanley, what we've done is we're using big data, and we're taking data from everywhere, and we're actually creating curves. And what we're finding is that while the absolute peak of the curve is different, the shape of the curve in every country is approximately the same. And so what that does is this then allows you to better form forward expectations, because really in our frame, we've got a five-step framework to determine what to do next. A big part of that framework is just trying to determine where is the peak in viruses going to be. That then determines when social distancing measures will start to unwind. That will then inform how the restart of the economy will happen. So actually, our view is that no, you should really be focusing on virus numbers. And what we're seeing here is quite encouraging, to the perspective that in Italy, clearly the peak is behind there. So that's one of the big hotspots. We are definitely watching the fact that both Japan and Singapore seem to be getting starting to get a second wave. But again, that is something that we're watching very carefully. Clearly in the US, because of the fact that they took so long to start social distancing, what we're expecting is that we're probably going to see a double hump, meaning that we will see the peak on the East Coast, West Coast first, followed by a subsequent peak somewhere in the middle. But we think at this point, the peak in the US is probably about 2 to 3 weeks away on the East Coast, and then 2 to 3 weeks thereafter in the US. In terms of the virus outbreak here in Australia, I think it's worth mentioning right now. We're doing a great job in this country. We can look at the positivity ratio, which is at 1.7%. That's down from 2%. That compares to a positivity ratio in the New York right now of around 50%. That measure is for everybody who does a COVID-19 test, the number of people that are coming back positive. So we're basically getting 1.7 out of 100 versus 50 out of 100 in the US. That's a great number. Now, the key thing here, though, is that we need to keep it up. We need to be following the direction of government. We need to do what is in the nation's best interest, which is stay home, do more Zoom, allow the virus to get under control, allow us to get surveillance in place, allow us to be able to manage the outbreak. I think one of the other important things as well is that let's take advantage of our geography. We're an island. Let's close the borders indefinitely and just keep ourselves sort of away from getting that second wave of infections as people start re-entering the country. So I think just in terms of sort of wrapping up, I think what I'll share with you is just at a high level where we think we are at this point. So you have to remember, we started de-risking client portfolios back on February 10th when that Chinese data started to come out and started suggesting to us that things are starting to look pretty bad. We reached what we call maximum defense maybe about 2 or 3 weeks ago. And it was at that point where we felt that things are starting to really get out of hand. But it was also within a couple of days after we got to maximum defense that we started to see the howitzers rolled out by federal governments around the world. And make no mistake, those fiscal and monetary responses by governments, while this doesn't solve the medical problem, it lays the foundations for a recovery that the firm is now expecting in the second half, because we do expect to see the peak in COVID cases by May. So in that five factor model that we're using, COVID cases is a big one. We're looking at May as sort of that as sort of a key date in the way that we're managing our portfolios. The other four things that we're focusing on are really just around earnings and multiples. As Kylie was suggesting, there's a lot of moving parts there, but the one thing that we can point to is that we are encouraged to see that earnings expectations have finally started to really come down to reality. Just looking at the ASX, for example, looking at 12-month forward numbers, 12-month forward EPS estimates are now minus 18% year over year. That's a good start. That's basically getting into the realm of realism. The other thing we're looking at, of course, is the ERP, or the equity risk premium, specifically for the U.S. market. That is still sitting above, traditionally when it's around above 4.5%, that's generally a good place to start adding risk. It's still sitting at above 4.5%, so that's looking really positive. And of course, the last factor in our model, as I sort of alluded to earlier, was really around policy. As I said, we've got the major policy responses from both governments and from central banks around the world. Those will be laying the foundations for a gradual recovery that we see in the world economy. But at this point in time, as I said earlier, it's beholden on all of us collectively to do the right thing, stay home, and let's get this virus under control so we can all get back to work.
We now have 18, perhaps 20 minutes left to dive into the Q&A.
Yeah, well, I think Nathan touched on the first one. Underemployment's critical. I think we're going to see a massive uptick in the amount of people who are still employed, but their hours have been cut. And of course, that doesn't just apply to casuals and part-time workers, but I think even you're going to see a lot of, I'm hearing stories of a lot of full-time staff who have been asked to work 4 days a week. So underemployment is critical. And then really, for me, in terms of economic performance, the way to capture that is hours worked. In terms of the social consequences, sure, the underemployment rate's important. But the hours worked data is critical there. Why did the RBA not go out further? Look, I mean, the RBA, I think there was a lot of volatility in the market around the announcement, and the 10-year part of the curve, of course, was not functioning well. And I think in terms of Kylie's data, if she'd just taken a snapshot of the week of the RBA's emergency announcement around yield curve control and just focused on the Aussie 10-year government bond, she would have had a whole new lot of records set, because the bid-offer spreads are all over the place. But they're looking at, they're trying to conduct their monetary policy for the real economy. And I think it's all settled down anyway. And then the final one is, look, Alan, you've got great expertise in energy, in electricity. So if you can provide me with some daily electricity data, that would be wonderful. You can send that through on my email. I think it would be fantastic. But no, seriously, you're exactly right. And look, there's a couple of really good private sector players out there who are tapping into these digital data sources. I'm thinking of Alpha Beta and their report with Ilion that we saw last week. And even the bank economists, I've seen some of their stuff. So very good point. Unfortunately, this speed of this event does highlight some of the problems with our traditional statistical gathering methods. And today's number from the ABS, I think it's sort of funny, right? That we know what's going on, and they've released this number that's just completely irrelevant to what we're trying to work out.
Thank you, Warren. And maybe we could have a look at the next question, which was number 5 in the sheet by attendee Ray. And maybe Kylie and Nathan are the ones to look at this. Why are the stock markets recovering so fast, despite the looming unemployment figures and economic impact so far? Significant recovery has been seen in the AU index as well as the US indices.
You want me to have a crack at that, Kylie? Yeah, sure. I'll have a go at that, Gerhard. First of all, always remember that the market is forward-looking. I think people forget that a lot of economic data, while important to validate where we came from, a lot of the stuff always comes out with a delay. So there's that element. That said, pretty much everybody knows the data in the next couple of weeks and months is going to be horrific. I think Vimal was absolutely right that people are going to see some horrific economic numbers. The key point that we want to make and we've been making this with our clients, is just that this is as Warren suggested, a kind of vanilla recession, in a sense that this is like any other recession we've ever had. there is a fall in supply and demand. It impacts corporate profits. People get unemployed. Defaults go up. Right. That's the normal playbook. What's different about this one is just the velocity of it. So everything's happening faster. And so that's the reason why we're seeing the markets also reacting so quickly, because again, it is unprecedented how quickly governments have responded both on a monetary and fiscal front. Just as an example, the US government, it took them something like 3 or 4 months to put together the first rescue package post the GFC. This rescue package that they put out, they did it in 5 days. That is pretty remarkable. You're spending something the equivalent of 10% of GDP and you pulled it together in 5 days. That is unprecedented. And I know that word's being overused, but that is clearly the case. And so as a result of that, it is a firm's view that now is the time to actually take a very deliberate and incremental approach to your portfolio with risk. We are pursuing a dollar cost averaging strategy. We are adding risk back to our portfolios, really, but fully cognizant that we could see the markets revisit their lows, but we're prepared to buy again. So we're just being very gradual, but I don't think at this point, given the sheer size of fiscal and monetary policy and our expectations on how COVID-19 is going to evolve from here, that you should be sitting in full defense.
Great, thank you, Nathan. And probably I can go to an interesting question of actually a UTS finance professor, Kathy Walsh, at the very beginning, which some may be interested in. Let me go back to that slide. Sorry, we have many questions here. Kathy said, Professor Kathy Walsh said, the withdrawal of superannuation money, this seems to replace a short-term problem with a larger long-term one. Maybe Warren, or if you had a view on that topic, please. Just, I assume many in that.
Sure. Well, look, I think what we're hearing is there's just a flood of applications to withdraw super early. There's a whole lot. This is a fascinating story, and I think there's a long way to go on it. But I'd like to say 2 things about that measured demand, or that demand we think we're picking up to withdraw super. I think some of it's related to genuine financial distress, as per the policy, what the policy is there for. I think also some of it reflects the fact that what people view super, and that is they want to get the money out. They don't want to have it locked away. So I think that's really important, and that's going to become, I think, potentially part of the political debate going forward about the superannuation system. It already was some questions over it, so that's that point. And then the other one is about the functioning of the system. We knew there was a huge amount of illiquid assets in there, particularly in the Australian industry funds. And they probably shouldn't have had to model a pandemic and a government policy change for withdrawal. And the reality is the amount of money that potentially can be withdrawn is quite a small percentage of the total pool of money. But there is a liquidity event going on. So I think there's going to be some real questions around that. And there's obviously a couple of funds that are in the spotlight there. So I think the whole super story is going to be a big one in the next 6 months. And it could potentially not just be an economic and financial story. I think it could become a political one.
Thank you, Warren. And let me drag you over to another question by David McDonald, who's talking about the housing affordability. I'm sure that many people are interested in that too. David says, hi, Warren, we've been talking about housing affordability for a while now. Is this the event that sees a big price drop and improved affordability?
Yeah, look, it's a tricky one. Kylie has done all this work on the lack of functioning of the world's deepest, most liquid markets. So I'm not sure that we would describe the Australian property market as functioning well right now. So we're going to have to wait and see what happens there. But we saw a 15 to 20% real decline in house prices through that cycle. That's sort of one of the reasons we had a downturn in Australia in 2018-19. And that's pretty significant fall. We saw that actually had macroeconomic consequences. And I think there's a couple of ways to think about this. There's no doubt this is going to have a negative impact on house prices. It's just about magnitude. So if we go back, 10, 15%, given what's going on more broadly, I think that's not great, but that's, manageable, and it's not going to, have a big issue. The bigger issues related to housing are around, the solvency issues, the people who are unemployed, whether they can pay their mortgage, all that sort of thing. But, in terms of what property is as an asset class, because clearly there's a huge amount of investment money in there, I think that's the real issue here. And I'd point to two things. One is, if we are having long-term economic and financial distress, more the Vimal view, I think we could safely say, then property actually becomes an attractive asset class. It becomes a defensive asset class. That's what history tells us. But then I think the other thing is that you're going to find if you get a financial crisis, you're going to struggle to see funding for property. And look, I think the real issue around the moratoria around mortgages, you're going to see the distress coming through the investor side, because as Nathan pointed out, a lot of the job losses are happening in areas that have a lot of part-time, a lot of casuals, and the reality is a lot of lower income workers, and they tend to be renters. And so where you're going to get the impacts is for landlords, and we're seeing that already. And then that's going to be the distress that goes into the banks. So look, don't have a hard number for you, but I'd say pencil in prices down 10 to somewhere between 10 and 20. And I think that's the range on a pretty middle of the road economic outcome. And if there's a risk to that, I think it has to be to the downside. That is a more severe economic outcome.
Thank you, Warren. And maybe I can also pick Nathan's brain, but I'm going back to Josh Snow's question. Nathan, maybe you can comment on both asset classes. Josh is asking, Nathan, what are your thoughts on the direction of oil markets? But maybe, Nathan, I could include the real estate question into that. Perhaps you have a view on different asset classes anyways.
Okay, let's start with real estate first. First of all, in terms of just like the transaction element, so like the business of real estate, clearly that's going to take a hit. We've already seen that in terms of new listings down quite substantially. We look at the experience in the US and the UK, where new listing volumes are down 50 to 80%. So that gives you an idea of the sort of order of magnitude that we can sort of be thinking about in terms of the business of real estate. In terms of the price of real estate or property markets, I think we would concur with Warren that something in that sort of low double digit sort of range makes sense. The number from the top of my head, I think we're modeling is around 10-ish% as well. And you're right, it's really driven more by that pressure on underemployment, and I think we would concur with the pressure on the rents as well. In regards to the question of oil, if I can summarize the firm's view here, it's basically lower for longer. We know that Russia and Saudi Arabia came up with that 10 million barrel agreement to take supply off the markets. Unfortunately, we think in reality, probably only about 6 million barrels of it's actually going to get implemented. On top of that, we don't think it's enough in terms of bringing the markets into balance. And as a result of that, and given that the recovery is probably not going to be robust and it's going to be incremental, that would also suggest that oil prices will stay depressed for a while. I believe our long-term number that we're using, like 18 months out, is $45 a barrel. So not a whole lot of upside from here in an absolute perspective.
Great, thank you very much, Nathan. And I'm perhaps going over to Bosco Tan's question, which was I'm sorry, I need to find the question. Bosco is entrepreneur and previously associated with the Zip company. His question is, how are the economic models capturing different scenarios around vaccine therapeutic solutions for the virus? What's the dominant assumption that seems to be prevailing in the forecast models? That's probably, again, something that Nathan can probably start with, and then we can see if Warren has a view.
My understanding on how the models work is that we're not factoring in vaccines or therapies. What we're recognizing is that social distancing seems to be the primary tool that is working around the world, and that's where our modeling is based off of that. Clearly, the resurgence of cases in Singapore and Japan does sort of bring into question and does highlight some risk around our view that we will see a peak and things will get under control. I think it just reinforces the idea that we need to be incremental and deliberate when we think about unwinding some of these social distancing measures, and to not take it for granted that this is actually a very contagious disease.
Sorry. Warren, go ahead.
Yeah, so in terms of the economic models, you know, I think as I referred to in my presentation, the BIS was the one I sort of had a look at, because they're obviously very important vis-a-vis banks and bank regulation and everything, and how banks are doing their own modelling around impairment and so forth. And they have admitted that, you know, the economic models are not going to cope with this. And look, the reality of economic modelling is they're a tool. They're a tool that you use as a system check, a consistency check, but also as an analytical framework. And in this environment, the speed with which it's happened, the unique nature of it, all suggests that you need to use all your different tools, models being one of them. But look, thinking about, as Nathan said, social distancing is our key strategy. We adopted it from the get-go here in Australia, and I think most countries have had to, simply because we don't have a vaccine. As Vimal suggested, vaccine may not ever come, who knows? And therapeutic solutions, obviously, are something sort of in the middle to some extent. But the reality here is social distancing is sort of the reason that the economic damage is being done. So if we get some sort of therapeutic solution that's satisfactory, or a vaccine, and that is a significant event from an economic and financial point of view. And I don't necessarily have any view on that, because I don't have any of that expertise. But yeah, that's why I think, you know, the way markets are reacting to, you know, case counts, and at least maybe not so much these days, but, you know, a couple of weeks ago, was a little bit sort of silly, because the countries that were getting the best outcomes from a spread point of view were probably doing the most economic damage, because, you know, they were doing the most intense shutdowns and so forth. So that would be my perspective on it. And I think that the summary is it's just one tool. We've got to use all our tools at the moment.
Thank you, Nathan. I want to, sorry, Warren, I want to acknowledge a couple of questions that came through that have been answered. Ian Ritchie asked if the government debt will ever be paid back. I think Vimal had an answer to that. And also Harsh Agarwal had a question. All the government provided stimulus packages are short-term, and by the rate on how the virus is spreading, where do we see ourselves after that time?
Yeah, I just make a comment there that I think the operating horizon in Australia is definitely 6 months. The operating horizon in other countries might be that 2 to 3 months, but here in Australia, it's 6 months. All the packages are set for 6. And I think one thing that doesn't get talked about a lot here is that, you know, lucky country is all about this happening in our summer. A much easier environment to get on top of this. I think, you know, obviously we have had some very good policies, and the health response and everything's been good, but don't underestimate how important that it is happening in our summer is, and we have to get through our winter. We're taking on a suppression strategy. So look, I think the 6 months is the right time frame, and his question's exactly right, as I alluded to. What after that point? Now we don't know either way, but at the moment, as it stands, is that's our next major risk zone, I suppose, is in 6 months' time.
Let me pull up one more question from Martin, La Trobe University. Considering that the age group significantly affected by this pandemic are the elderly, what would be your advice regarding providing more safety nets by the government?
I'll have just a quick crack there at that one, and I just recognise that there's been quite a few views put out there that what we should really be doing is, obviously the testing piece is critical, but, you know, we shouldn't be doing sort of heavy duty restrictions over 6 months. We should ease back now on things over the next month or two, and maintain the high level of restrictions on the vulnerable people. And of course, if we were to adopt that approach, then I think you would have to have associated with that, you know, more than, you know, just the edict that, you know, people over 70 can't leave the house. You would have to have some supports for them in terms of both financial, which they're getting some of, but the pension hasn't been doubled, as I understand it. They're getting supplementary payments, and also things like deliveries and so forth. But my observation, for what it's worth, is that although the people over 70 know they're vulnerable, they're just as keen as anyone else to get out and about in this environment. So good luck keeping them in the house. But yeah, look, I think that you definitely want to be looking to provide support to them if indeed they have to be targeted.
Thank you, Nathan, for your visit. We know that Vimal has already moved on to his real-world job. Kylie, thank you very much as our finance academic here in the round with significant, of course, industry experience.
Well, just thanks to all our participants and and everyone who dialed in. I think it's really worthwhile having these discussions. As a public institution, I know all the leadership across the business school, the finance discipline group, and the university more widely want to be playing a role in helping people to understand what's going on, and I hope we can continue to provide these sorts of services to the broader community and to all those people associated with the business school and the finance discipline group. I hope you found it very useful, and I just want to emphasize these are very much early days in terms of our prognoses, in terms of the data we're using, and I wish everyone all the best and to stay safe.
Great, thank you very much, Warren, and we'll see you next time. Thank you very much.